Hi, I'm David Harmon. I'm with my partner Keith Cook, and we're with RE/MAX in Bellingham, Washington. And today we're going to go over some creative financing options when you're looking to purchase land or property.
Thanks for watching. So we get this question a lot: is we find a cool property and then how do we go about buying it? So just kind of starting reverse a little bit and just say, like, what is traditional? So if you're looking to buy a property, either you're going to go in and pay cash, which is great, but not everyone has, 100% of the financing.
Right.
What's then more typical is if you were to get more of a conventional type of bank or credit union type of loan where you put a percentage down, the bank qualifies you, they lend you the rest of it. So pretty easy if you're putting anywhere from 5 to 25% down and the bank comes up with the difference.
Yeah, I mean, obviously, cash is the way to go for a lot of people. If you want the easy button, there's usually no contingencies other than you have to have enough money to purchase it. So, and then obviously bank financing, where you actually have to qualify through a lender to get that.
A lot of what we're looking at is how to get creative and how to try to put a transaction together when sometimes it doesn't seem like it's possible. It's like, what do we do or what's in our tool bags to try to kind of help create a sale? And I think some of those is just trying to get creative.
Yeah, I think going back to that creativity is seller financing. A lot of people ask about seller financing. Maybe they can't qualify for a loan on the buyer side, or they don't have enough money down. They're looking to get into something with lower money down without the maybe they have some hiccups on their credit and they're just looking for somebody that's going to help them out on the financing. As far as the seller goes, seller financing has some upside options. Maybe your property isn't financeable. Maybe there's some issues with it. Maybe you don't really want to pay the capital gains right up front. So that's kind of a tax strategy for some people selling on owner financing. But yeah, it's a great option.
Wholeheartedly agree. And that's where I think if we go into a situation like best case scenario for everyone, which we always try to do, that's always our main goal. I think it's just explaining options. And so you hit on a couple of things. And so you have to look at this from the buyer standpoint and from the seller standpoint. So from the buyer standpoint, it works great if you can't conventionally qualify, or even if you can. Sometimes the owners can make a owner contract more attractive. And it's a lot easier than looking for for cash. And we sell all kinds of properties, development properties, multifamily and residential. So it depends on the situations. Sometimes on like raw land, it makes it easier. It's more attractive for someone to offer as a buyer to say, I can buy this and just make monthly payments. I don't need to go qualify. I don't need to talk to the bank. I don't need the appraisal. So there's a lot of benefits from a buyer standpoint.
Yeah, and actually, so in the seller financing portion as well, you actually go through the same process. So you actually generally go through escrow, and the buyer will actually get title deed to the property, which is a great asset for the buyer because they actually have true ownership. They're not waiting down the road possibly until the thing was paid off or got to a certain point where they actually got title on it. And then from the seller's point of view, they actually have the same process as a bank would have, where they actually would, if somebody defaulted on that, they'd actually go through the foreclosure process.
I agree. And the three types of like creative finance we most likely would be looking at would be seller financing with either a promissory note and a deed of trust. And that's where the seller actually deeds the property over to the buyer, and then what is recorded against the property is also a promissory note, or actually the deed of trust is recorded against the property, showing that it is subject to that loan. So that new buyer is actually on title. That's the only one where it actually puts them in title. The other two would be a real estate contract, which is similar. It's still recorded. There's title insurance. But the document is it keeps it in the existing seller's name, but it's subject to a real estate contract. So those usually don't happen as much, and that has a different qualifications for in case of a default or taking the property back. And the third one that comes in where title isn't, it's the lowest level is like a lease option, or someone has an option to purchase a property, not a first right of refusal, but an actual option. So that you have a contract that says I can buy this subject property sometime within whatever time frames are negotiated. And for sometimes the seller may not want it to close earlier than a date or later than a date. And it really is, it's trying to listen to what works best for all scenarios and try to put in a contract and help people understand there are some options out there.
Right. Yeah. And a lease option, sometimes you see it on like rental properties. Maybe your landlord wants to sell the property, you're renting it, and perhaps they would do a lease option. So they would possibly raise, your price that you're paying in rent over a little bit over market value. So maybe you're paying an extra $300 a month on your rent, and that $300 over a period of time is going towards your down payment and the purchase price of the home.
So there's going to be your situation, either you're a buyer or a seller, and then trying to figure out how that situation potentially could work with the buyer or seller, and then figuring out your tax implications, your financing implications, what your goals are, what to do with the proceeds if you're a seller, or if you're a buyer, how your closing date would work. So we really do need more information to try to help put this together for you. And it's somewhat, the term I use quite often is whack-a-mole, which you would have to look at. All of these would kind of have a cause and effect on each other, because if you knock down one, another one may pop up. So let's just say usually the whack-a-mole options or topics are the price, what someone will pay for a property, the interest rate, if you're going to carry back financing, what's that interest rate? Because and both parties are coming at this wanting a different thing. The seller would like as much money as possible, as high as interest rate as possible, and the buyer would like the reverse of that. So how do these affect each other? You're looking at the term. How long does the contract go when it's actually due? The monthly payment. How much of it is the monthly payment, and then how much of that monthly payment is actually towards interest or towards principal, and then what is the down payment? The initial seed money to get it going. And then sometimes there can be balloon payments as well, and then responsibilities. And then also saying, like, when is the closing date? Does this contract start next week or a year from now? Like, when are funds due? And so all of these things kind of are contingent on each other. And there can be ways to structure it from a seller standpoint. If, let's just say, there's taxes. A lot of times if someone has owned a property for quite a while, the old school way of selling a property is an owner contract. And a main benefit for a seller is, say you had someone who's owned a property for, let's just say 30 years, they have $1 million equity in it. What are they going to do? All of a sudden they sell it, they have $1 million. So right off the bat, you have to assume that they're going to owe, say, $200,000 just in tax. If they were to sell it, do nothing else, they do their taxes that year, they get to ship off Uncle Sam $200,000 in taxes. So elderly people don't like that. As much as it does take help society and pay for, I don't know what you can get for $200,000 right now, a couple toilet seats for the space shuttle or wherever you spend it. But so the way to save that, so now let's just say they had $1 million. So now they have $800,000. They sent Uncle Sam $200,000. So they have $800,000 to invest. So now you have $800,000. You're going to put it in the stock market. If you're elderly, that's super risky. I can tell you some stocks that aren't worth nearly what I paid for them. Or you put it in the bank, and you put it in the bank, you're going to get 1-2% interest. It's just not a great rate of return. So let's just say you're getting, quick math, you're getting 2%, 1% rate of return on 800,000. So you're getting 8,000 to 16,000 annually on your money. So you are making some money. It's just, and it's really relatively low risk versus the owner contract or financing. You're getting creative. You have that $1 million, you're still owed $1 million. And so you haven't paid the tax. That 200,000 isn't taxed until you receive it. So in some situations, owners want to keep these contracts going as long as possible because they don't want to pay that 200,000. So the longer you go without receiving it, then you don't have to pay it off. Now you're going to take that $1 million loan versus 800,000, and you're going to get anywhere between let's just say 6% interest in today's market, but usually between 5 and 10, but just say 6% for numbers. So you're going to be making $60,000 a year in interest versus $8,000 to $16,000. So it doesn't take that long, a couple years here and there, where you're doing quite a bit better. It's potentially not as risky as a seller because you know the property, you've had it for a long time. You have had a chance to check the buyer's credit out. You're comfortable that you're going to want to work with this borrower on the property. Plus, you're going to have, the monthly payment. You're going to probably most likely be able to sell it for a little bit more. So you got the $1 million instead of discounting it to $950. So throw that into the equation, and it's easier for a buyer to come in. So lots of reasons for a seller to want to do this. It's, there's still the monthly income versus if you're just putting all the stock, unless you're going to have some that give you dividends, you don't know what your income is potentially. So it's something I would say that you'd want to discuss with us, your attorney, your tax accountant, your family, your advisors, just depending on where the monies go. But from a realtor broker marketing standpoint, I think it's a very underutilized selling aspect of property. And the flip side is there's not as many of these that are out there. So the buyers are a little bit more in line or intrigued with the option of, I don't have to go talk to the bank, and I don't have to get the appraisal, and I don't have to qualify. And so it just makes it easier, especially if the property has some type of development aspect to it. You're not needing to necessarily wait for plans or permits or studies. You're kind of ready to go. You can close on it right away and then let the buyer figure the rest of it out later.
Right. Yeah, I think that's one of the greatest things that Keith and I enjoy about being in the real estate business and dealing with people, buyers and sellers, is getting creative and explaining things and looking at different options. Because when we sit down with, say, a seller, for example, and they want to sell their property, that's just the beginning part for us to dig deep and find out why they're selling, what their goals are, and what their what their intention is afterwards. So, and that's where this creative financing comes into play, because really when you start digging deeper, we can really find out that maybe a better option would be for them to sell it on, some type of a contract without just outright cashing the place out. And vice versa on the buyer side. If a buyer comes in and they just want to purchase a house or they're looking for an investment property, we try to go down all the avenues. Maybe they don't have enough money, and we can source money from a third party somewhere down the way. So it's actually just on our part too. It's just kind of helping people dig in a little bit deeper and really get to the root of the best path to take.
Sure. So we'll dig in a little deeper on each one of these three: promissory note, deed of trust, real estate contract, and the lease option. So just in real estate. Deed of trust and contract are pretty similar. So what it's going to take for these to work is property is going to have to either be free and clear, or with the amount of down payment that the buyer is bringing in, the property will be free and clear, or for some reason the owner is in a position to have the property become free and clear. So there's definitely advantages and disadvantages for a seller to go on a contract. But same scenario if they have $1 million, but if they owe $300,000 on it, can they do the contract or not? Well, let's just say the buyer wants to put $250 down. You can't do the contract because there's not enough money there to pay the first mortgage off. But there could be an advantage for the seller to want to do this. So there's some situations where the seller will bring money into the table in order to help close it, to finalize it. So the property has to be close to being free and clear, because the existing first mortgage on there right now is going to have a due on sale clause, which is going to require that the note be paid off. So there's some financing that needs to be figured out, and this all comes in how we're figuring out what's going to work for your situation. So there are ways to pay that off. Might be that you refinance another property to pay it off, or the buyer puts up more money. But so look at the situation that way. That's a main part of it so that's going to work for the promissory note. And it's also going to work for the real estate contract. So they're both pretty similar that way. The main difference, if I didn't get into it, was the promissory note is basically how you take the property back. So on a promissory note and deed of trust, the seller can go through, it's probably 99% of what's used locally is a note and deed of trust. It's the same as a mortgage. If you're going to go to the bank or a credit union, borrow money, what they're going to do is say, you put down your 20%, we'll lend you the 80%. You're going to sign an IOU, aka promissory note. And then they're going to record against the property is a deed of trust, which basically just makes reference and puts a cloud on the title that if that property is ever sold, that person owed the money saying, hey, don't forget about me. You can't sell it and keep the money. We need to get paid when this property sells because that's the collateral. It's kind of like a car loan. So if you were to go sell the car, it has to be paid off. You can't just go sell it and pocket the money. The real estate contract is similar, but the title doesn't transfer. So it's a cloud put on the title from the buyer saying, hey, look at me. The seller can't sell this property. I am in contract, and here's the terms of my contract, and I can close and put title in my name once I've fulfilled the requirements of this real estate contract. Usually that happens more in like farming type property, but we don't run into that as much, but it is out there. So just want to let you guys know it is out there. From both a buyer and a seller aspect of doing with a note and deed of trust or real estate contract, you can lose the property. So it's just like a regular bank type situation. There's going to be clauses in the contract that basically say if you don't meet the obligations, then the contract can be cancelable. So if you're supposed to pay every month on the first, and then you forget to stop making those payments, then there's a process to, foreclose or repossess or, take the property back. And that's a big risk. No one wants to be in that position. They put some money down, they make repairs and fix it up and then lose it. So if you're going to buy or borrow money, hopefully go in knowing that it's best for everyone is just to do what you say you're going to do on the contract. That just makes it so much easier for everybody. People get in situations where we went through this, probably 20 years ago with all these short sales and foreclosures, and it was tough. And so what's happened right now, even with interest rates where they've been low and then they go high. So it is tough. But I would say get ahead of it if you're in a potential dangerous situation as a borrower, and don't bury your head in the sand. And even if you are potentially going to be in a foreclosure, still look at trying to sell it and get out what equity you can, because either you can, get some equity out and move on and pay the seller off, or lose it all. And depending on how the note's written, there still might be personal liability after closing.
So a quick question, Keith, because I think that some people think like on seller financing, I need to do seller finance because I don't have any money. I currently don't have a job, but I really want to buy a house. What are the costs? People, I think, generally think seller financing might be cheaper to get into than a regular loan through your bank. Is that what are your thoughts on what it takes to financially, or maybe credit wise? What kind of stuff is involved in somebody when they want to do seller financing?
A great question. From the buyer and the seller standpoint, there's going to be two different scenarios. So on average, selling real estate, I would say, is a 10% cost that the seller pays. Buyer, say, has a 1% cost. So seller ends up paying, and the reason that's important is to know how much cash does it come in to clear title. So if you're a buyer and you realize, all right, before the seller puts 10 cents in their pocket, the first 10% goes out towards paying us. So you're paying the brokers. The seller pays the brokers. That's my favorite part. Title, which is title company, escrow, excise tax, and then their prepaid taxes and their some other small minor fees, just if they have reconveyance fees, or not much past that. So realizing that if it's $100,000, I want to buy something $5,000 down. Okay, that's not over 10%. So in that case, we're asking the seller to bring in money to close. And usually the seller's not going to want to do that, because if they're going to do a foreclosure, it could cost the seller between $5,000 and $10,000 just to foreclose on me and not having the payment. So most sellers, if you're doing a contract, I would say the gold standard for owner contracts is probably 20-25% down. And it all depends on what the seller's needs are. There's ways you can come in with less money and do like a cross collateralization, which we might get into later, but basically put up additional collateral besides just money. So you're trying to make the seller super secure that you're not going to give the property back up to them. The down payment, and it's a kind of a big question there, but so it's going to be based on the down payment. Right. It's going to depend on the seller situation and the credit. Most sellers aren't lenders. Most sellers aren't financing on a regular basis. So most sellers are looking at kind of abbreviated information. It's not scrutinized. It's one person who can make the decision of, not like a bank where it seems to go through a dozen of them to figure out with underwriting and processing, just the process that it works. So an appraisal is not required because the seller is selling the property. They don't have to have proof of the value because they already own it. So buyer doesn't have those costs, the loan origination costs, all of those fees that they would have, which most sellers are going to want to see. A combination of a financial statement, which is almost like a blank loan application. That's nice to have just so the seller has an idea who they're working with, and a credit report. And so the credit report is going to show the borrower's track history on what they've done on other sales. So those are two, sometimes it may be tax returns, but usually just so the seller knows who they're working with. It does make sense that the loan would have a title insurance, so it is insured. We can get into that later, why insurance is important, but
Right.
usually it would be a cost and why the buyer would provide the seller title policy.
So I guess, the takeaway on seller financing would be that, if it's a great thing, maybe if it's a family member or a good friend, or maybe you're operating a business, running a business for somebody, and they're going to offer you seller financing, some of the terms might be a little bit more generous in your favor just because you already have that relationship. But if you're going out on the market to try to find something on owner financing, that there's going to be some costs involved. It's not going to be a cheap little thing because, like as Keith was saying, the seller does have costs. So just
Right.
keep that in mind when you're thinking of seller financing.
Right. And back to the whack-a-mole where they all adjust. So it's something like, it may sound funny, but if the terms are right, I'd pay $1 million almost for most properties that are out there. Not every property, but even if it's worth 500,000, say it's worth 500,000, the reason I would pay $1 million is because it was on the right terms. So if let's just say it's renting for $2,000 a month, and I give you $1 million, it's worth say 600,000. If I go $1 down, so I put $1 down, you pay all the closing costs, I'm on title for $1, and I pay you $1 a month at no interest. So now you might get the $1 million, and I've got say 1,000 years to pay you back, or 1,000,000 years. So I'm paying the $1 million, or my heirs would pay the $1 million, but what I'm doing is I'm taking that $2,000 a month rental payment, I'm keeping $19.99 of it, shipping you $1 of it, and I did great for me.
Right.
But it's far fetched to think that's going to happen, but it just, in my mind, it shows the difference on interest rate or terms versus price, because I would have paid $2 million or $3 million for the same property, because I like the idea of getting that $19.99 a month. So the terms really are that important. So in some cases, as a seller, realizing what you have and how to market this, trying to sit down and kind of go over these scenarios. Is it just one parcel? Sometimes you may have a collection of properties, and we transfer it to where one property has the sale and the other ones may have an option, or with the potential to trade these properties down the road. So there's some things like, another old school way of selling a property is for the seller to sell the property and transfer it into a new property. So you take that $1 million property, transfer it into another property or two, and avoid the taxes. So that's a 1031, and I have a video on that as well if you want to get more on that, on what those situations would do. I think it's been around long enough, most people would understand what a 1031 is, but it's how to get creative on your sale. And it's kind of a combination of seller financing and a 1031. You might also do what we're going to talk about here a little later as a lease option. So you might use all three of them in the same scenario on how to exit real estate. And that's really kind of, what's your exit strategy? And I see some people, even if they're elderly, they've got a rental, it's free and clear. Why sell it? Well, they still have to be up at night worrying about, if the pipes froze or if it flooded or what's happened. And so you're really not retired in my mind until you've kind of liquidated some of that real estate. Even if you have a manager, there's still the liability of it. Versus an owner's contract, I think there's just so much more, because with an owner's contract, if the plumbing goes out, don't call the owner, call the buyer. They are now going to be responsible since they own the property. So the liability of that is vanished.
Right.
Some things that would happen that the owners can do, the borrowers are required to have insurance if it's a structure on there. So you would be put on as additionally insured. So it's like you have a lien against the title, you would have additionally insured on the insurance. Speaking of the title, the borrower would provide the seller, or even the property owner, a title insurance policy, because let's just say that same $1 million, you now have $1 million that you're collecting these monthly payments on, which works great right now. But let's just say in 3 or 4 years, you're like, I think I'd rather have my cash and I want to go do something else. Well, those are sellable. You have something that's so liquid, you're going to start, the day you sell it, you're going to start getting mailers because people want to buy this note. You are owed $1 million. People want to buy that. So my suggestion is, as soon as you sell that, start a shoebox and just start saving all these postcards, because you're going to get lots of mail from people who are interested in borrowing this. So I would just save them all for kind of shits and giggles. And then if some point does come down the road, call them all up if there's a point, and talk with us or someone too, and just see what's going to happen. The reason you're getting those is because it's a whole other business model of buying discounted notes. But if you're just rule of thumb is, if you have a note worth $1 million, some investment strategies are, hey, I'll come along and I'll offer you $500,000 for your note for $1 million. And some people are going to say, okay. And that's the whole business, because they just bought it for $500,000. They're owed $1 million. Someone could cash them out, 2 months later, and they didn't get the $500,000. They got the full $1 million two months later because they bought the note. So even on regular loans, when you see them transferred, all of a sudden you're paying a new transfer company or servicing, or it moves around. So same thing can happen on these notes. And it is a investment strategy for some people to find these notes and get out there. But there's a lot of different processes on who's going to pay you how much. But an important element of that is making sure that you have the title insurance. So in the event you do go to sell it in the future, you have an insured parcel already. So it's more attractive when you come to the point of, if you do decide to sell it down the road. It also does help to have the whole track history and all of the initial paperwork that you would have. So kind of package yourself so you're fairly liquid. One thing that makes it easier for both borrower and the seller or holder and maker, as far as who's with these owner contract notes, is dealing with, you work with actually a couple different third parties. So when the transaction closes like it's normal. So if you're cash or contract or financing, work with the brokers, you make the offer, and just in the offer, it kind of spells out the terms as far as, here's our financing. Our financing is, we're going to ask the seller to carry back the contract, and here's our terms with our down payment, monthly payment, and interest rate, and when the loan's due. But it's nice at this point to say, all right, how are we going to do the monthly math on what's happening? So let's see, if I'm interest only, it's fairly easy because all of the payment just goes towards interest. But the majority of these that we see have some type of amortization schedule. So part of the money is towards principal and part of it's towards interest. And each month, those kind of get bigger. So the principal is going down. So a little bit more of your payment is going towards principal. So how do you keep track of this? How do you keep track of it, Dave?
Yeah, generally there's going to be a neutral third party that's going to do the collections. So there's companies out there that specialize in collection of these, and then they manage the loan as well. So it's kind of nice because at the end of the year, you're going to get a report back for the seller showing how much interest was paid, just like if we were dealing with a bank. So on these, there's it's once again, it's spelled out in the contract who's going to be taking care of the money, so you know in advance who that person's going to be. And generally, there is a small setup fee. It's not very much, but it, like I said, in the big scheme of things, it really helps out because as the seller, you don't have to worry about bugging the person to make your payment, and as the buyer, you know exactly who's taking care of it and that you're getting taken care of by somebody that's a professional in it. You're not just dealing with a random person that you purchased the property from.
And we try to get people to work with these companies as much as possible because it takes all of the headache off the seller. So the responsibility is for the person that's owed the money. And a big, there's two parts of it, more than 2, 3, 5, whatever. But one is at like you're saying, the end of the year. So the end of the year, you have your earned income statement that if you have a mortgage on something, you've seen them, like how much went towards principal, how much towards interest. So that's required. And that's worth a few $100 just to do all the math on that. And then have it go through a company and keep track of it monthly. And so it could all be electronically. And usually it is set up electronically, but someone's just kind of keeping score. So you'll have a monthly score as far as what's going on. Are all the scorekeepers the greatest in the world? Probably not. Should you still keep an eye on them? Probably so. And it's not like they are the police on it for when payments are made or not. So it is your investment. You do want to pay attention to it to make sure if they're missing or go through. So set yourself up alerts. If you're supposed to get a deposit on a certain day of the month, if it doesn't happen, you want to keep track of that as well.
Right. Yeah, it's kind of like when Keith and I play tennis. If he hits the ball on the line, I say it's out. He says it's in. It's nice if there's a referee there that can say whether it was in or out. And that's basically what the third party person is doing in case there's discrepancies or whatever. Once again, the seller doesn't have to bug the buyer. The buyer doesn't have to bug the seller. They know that third party's there to make the right call.
Right. Absolutely. So I guess in conclusion on this, promissory notes and deeds of trust and real estate contracts, there's a lot of little small nuances with it. And I think it's opening yourself up to look at being creative, looking at your long-term goals, seeing what would potentially work from the other side, from a buyer, what's your exit strategy, and just trying to look at the whole picture. Is it part of a larger grouping of properties, or what are your longer-term goals? Are there family members who might be interested in it? So usually when we sit down with people, it's usually elderly people who have enough equity to sell in these contracts. And I think it's just looking at what are their goals, talking with their family members. We try to talk each other out of, or other folks out of, as many sales as possible. Because for us, if we can talk you out of a sale, that's great, because you'll think we're straight shooters, which we are, and point you in the right direction, or if it works for a family member. If not, just kind of going through what some of the options might be. And I think there's a lot of aha moments when we sit and meet with people, and it's looking at everyone's situation individually. And that's the fun part about this job, is it really does change with a case by case scenario. No two situations have ever been the same. And there's a lot of different situations. So sitting down, going over your situations, financially, I think we get more involved on probably some of these owner contracts than we do with most buyers on traditional sales, because usually we're like, well, go talk to the bank or lender and let them figure it out. So the fun part for us is with this, helping someone figure out what's a good option for them, and how to help diversify their portfolio, or even if this is the main part of their portfolio, how does it work for them in the future? So lots of moving parts, lots of moles to whack. So there you go. We're going to dig deeper on another one, like lease options. So be sure to check out how lease options work, or hard money financing too. So we do have more creative financing videos. This one seemed long enough just on real estate contracts and deeds of trust.
Thanks for sticking with us through this. Great topic on seller financing. If you want some more information, we're going to dive a little bit deeper in some other videos on like hard money loans, lease options, some of the other creative financing stuff. But yeah, make sure to like and subscribe to our page. And yeah, thanks for checking us out.